Paul, we're in love with this book, Richer, Wiser, Happier by William Green. I'm so close to finishing. I'm like literally on the last few pages of it. I've reread the first chapter a couple times because I'm really drawn to Manesh Pabrai. But it talks about the most famous value investors, most profitable and value investors in the past century, and the steps they took to get there. And Paul, I was shocked because if you talk to normal people in this world, you buy a stock, you hope the ticker price goes up, you sell it at some point, which most people don't even know when that occurs, and it's a hoping game. It's risky, it's dangerous.
I hear it's called the casino.
It is gambling, and it's a cluster F. In fact, I was lifting yesterday, and a dad was telling a son that the stock market is a complete fugazi. He said that they have top analysts picking versus a dartboard, and the dartboard can win. And there's really no way.
He's actually right about that.
And there's really no way you could predict any of this stuff. And then literally, I'm telling you 2 minutes later, all I heard, he literally said the words, "Bitcoin's up today." And I, of course, almost melted in my shoes like the Wicked Witch of the West. But the point is, Paul, is everyone thinks buy. What am I buying? And not only do we teach you as a viewer, as a value investor, to avoid most of this nonsense, but really take into account in Richer, Wiser, Happier, the idea of what bad could happen. Charlie Munger has been successful his whole life by not doing, how can he avoid stupid things? And so all this rounds up the idea of a margin of safety. What is my downside risk? What could I lose in this investment? And if I can reduce that, I'll be a better investor. So talk about this idea of margin of safety.
So margin of safety is when you go onto Instagram and you follow me on Instagram. That is your margin of safety in this video. You go in there, you click my little button, you follow me so I can get a blue check mark. So there's a guy named Seth Klarman. Seth Klarman's a great value investor. He wrote a book called Margin of Safety. They only had 5,000 copies run. I have one of them. But it's a very well-known book because it's a very well-known statement and term in the value investing world, right? It's funny you mentioned that dad was talking about Bitcoin. One of the most important factors of margin of safety is being able to have a value to something, right?
Yeah.
Whenever I teach this high school, Seth and I went to high school together. Went to Walsh Jesuit High School in Cuyahoga Falls, Ohio. Or is it Stowe? It's Cuyahoga Falls.
Yeah.
In that high school, I go back and teach a class there because I just like teaching. And the first example I give when people say, when I'm explaining what I do for a living, I say, guys, who here has an iPhone?
All of them.
Everybody has an iPhone. Who loves this iPhone? It's wonderful. Okay, what's the iPhone worth? And invariably, I get people saying $1,000. That ends up being the number, right?
Yep.
So I sit there and say, guys, is it better to buy this iPhone for $500 or $1,500?
Quite obvious. You want to buy under.
Right. This is my margin of safety. It's worth $1,000. I'm paying $500 for it. My margin of safety is $500, which means there are things, the future is unknown, right? Mm-hmm. We never know what's going to happen. That's what makes investing so difficult. Investing is difficult because we have emotions. We don't know the future. And when the stock or investment starts to go the other way, we start to doubt our decisions, right? The whole point of this is your goal is to buy plenty of investments with an ample margin of safety, a difference between what you perceive it to be worth, what you valued at, also called its intrinsic value, versus what you're actually paying for it. Because if you buy it on a large enough group of investments, you'll probably end up paying way less than the overall group's actually worth. You're gonna be wrong in a few. Maybe a few of them aren't really worth $1,000. People don't remember this. Warren Buffett's had companies go to zero. He's invested in companies that went to zero, or he was invested in companies that he had to write down 80% of their value within a year. Because he's like, you know what? I got it wrong. I valued it this, it wasn't this. There was an Irish bank just a few years ago. He bought for like $380 million. I think he wrote it down to like $50 million after he bought it. He's like, hey, I made a mistake. I didn't understand the investment. And there you go. So the whole point of margin of safety is, the first step is come up with intrinsic value. Intrinsic value is the value you come up for the asset. I don't care what the asset is. It's basically what would somebody pay in a reasonable market for this. Not in a crazy high market, not in a crazy dead market, in a reasonable market, right? Like when I was buying real estate in 2009 and buying stocks in 2009, that was a crazy market to the downside. But buying real estate in 2006 was a crazy market to the upside.
Yeah.
I don't value it at either extremes. I value it somewhere in the middle. Mm-hmm. I think this stock market is a very crazy high stock market. So I'm not valuing the company based on what the current multiples are. I'm sitting there saying, okay, in a normalized stock market, based on history, what would this asset be worth? Now, once you figure out intrinsic value, you need to determine what kind of discount you want for that. It depends on the company. The smaller the company, the bigger the discount should be. Why? It can go out of business a lot easier. Is it easier for a $100 million a year business or a $100 billion a year business to go out of business?
Sure, a smaller one.
Right. Also, when it comes to smaller businesses, less people are following the small business, so there's more likely to be a discrepancy between intrinsic value and the price. But the first and foremost is intrinsic value needs to be greater than the price of the company or the asset at the time.
Absolutely.
Right? Yeah. The bigger the margin of safety, the better. Gary is a guy that I invest with. I put some money in him.
Gary
right?
Mashiris, yeah.
He told me the other day that he has his current portfolio that he has invested in me. He thinks it's currently selling for 53% of intrinsic value. So he has a 47% margin of safety in what he perceives his assets to be worth. Now, sounds easy. Well, the hard part is look at what's happening with Alibaba lately. Alibaba is a company that's it's been tanking. We looked at it when it was $300 a share. I said too expensive. Now I love it. I started buying it at 184. Then it went to 180. Then it went from 184 to 205 to 180 to 170 to 160 to 155. All this time, you're questioning, am I right? That's what makes investing hard, right? Because the stock doesn't go and just go up immediately over long periods of time. It is easier over long periods of time to determine what an investment will do. It'll basically go to where the earnings and cash flow take it. As earnings and cash flow increase, the multiples will stay the same. And let's say, for example, you're always going to pay 15 times a company's earnings or free cash flow. Guess what's going to happen? As they increase their earnings and free cash flow, that number becomes larger and larger, right? So margin of safety is merely the protection you have between what you perceive the value to be and the price. The bigger the margin of safety, the less I always laugh when people say risky asset. What makes an asset risky? Merely the price you pay for it. The less, because risk is risk. The definition of risk is basically what are your chances of losing your capital. Where the less capital you put into something, the less likely you are to lose money, right? You're going to lose less money. But everybody always comes up with it's beta, it's volatility. No, there's a difference between volatility and risk. Something that the price changes like this can be less risky than one that price goes like this. Why? This is volatility. This risk is how much is this right here. It's not the change in price, it's the difference between intrinsic value and price. So not only you have to understand all these concepts, you have to go search through tens of thousands of assets to find the 20 or 30 that make the most sense to you. That have the biggest difference between price and intrinsic value.
So what we see with a lot of other YouTube pages, so-called investors, is they're talking about exciting IPOs, the record number of SPAC mergers, companies that literally don't make any product at all, which they call now pre-revenue. They also don't make any money, yet the stock is a high-flying, multi-billion-dollar company based on nothing. So where is our margin of safety if you have invested in these companies or they're in your portfolio right now?
So the future governor of California, meet Kevin.
Yes.
He has a video in which he talks about Tesla. And in his video, he analyzes Tesla, which I love. He did it in Excel, but then his assumptions were obscene assumptions. 70 times PE 10 years from now. This revenue growth of 30% a year for the next 10 years. I can make any assumption in the world to make any company look like it's a good value today. But the intrinsic value is also determined based on historically reliable metrics that aren't, like I said, it's not based on during great times and bad times. It's somewhere in the middle. Because over long periods of time, the average will come through. So if you make insane assumptions, give me any stock. Amazon, worth $10,000 a share. Why? Because I made these assumptions. I could also make it worth $100 a share based on my other assumptions. But at some point, you have to make reasonable assumptions.
Yeah.
That's the key part of investing. And it's very difficult to make reasonable assumptions when the market's being crazy. And I see it even more now with real estate. The assumptions being made are insane assumptions. Well, we're going to have revenue growth for 6% a year. Why? Well, we got it for the last 2 years. What did you get for the last previous 8? Oh, well, when you're assuming things that are not reliable or short-term assumptions, you're going to have problems. Your intrinsic value needs to be based on a reasonable assumption. And you want to find your margin of safety by finding a big gap between reasonable assumptions and today's price. That is the very key to margin of safety. The bigger the margin of safety, the better you're going to do.
What is going to happen to these TikTok investors who have YOLO'd a lot of money, borrowed money?
Every time in history when the average kid is getting involved in a certain asset, it ends up being bad. It might take a while, but it ends up being bad. Mm-hmm. Look at a thing like Bitcoin. There's no way of telling me what intrinsic value is. They might sit there and say, well, the cost to mine is intrinsic value. Okay, maybe so. But at the end of the day, it's not like gold where the cost to mine something and then gold is used for many things.
Yeah.
Especially like jewelry and things like that. Bitcoin's not used for anything besides what people's perception of its value is. Oh, that's no different than the dollar. Yeah, but the dollar's backed by the US government. Oh, the US government's broke. Okay, but then you're the same people who want the US government to be broke by, it's just a vicious cycle. Mm-hmm. With a company, you have a steady stream of cash flow. Hopefully it's growing and increasing. And you can use this simple calculator to say, this is what I'm willing to pay for it based on my requirements for returns.
If you're drawn to this, you can join our Patreon below. Click the link. You can join 5,300 patrons in our group, our community, all over the world, Paul. We're huge in Latvia, Paul. You know that. And like-minded people discussing these very topics, finding a nice margin of safety in some of these companies, and only investing in what we perceive to be really good deals, great companies at a cheap price. That is the value investing way. So that's our thoughts. Fondle a thumbs up, and we'll see you next video. Thanks for watching.